Andrew Stafford, president of Prevail. I'm here today to talk. A lot of times we get asked about what's the difference between traditional investment philosophy and how you guys go about not only managing money, but really creating wealth. So what I want to go through today is a couple of things as far as how we built this organization and why it's different. And so with traditional money management, you're going to go through some form of general risk tolerance. And they're going to come out and they're going to determine, you're a conservative, a balanced, maybe some form of growth investor. They're going to tell you that it's actively managed and they may make some adjustments inside of there. The reason that they do this primarily is because of what we'll refer to in the industry as assets under management, or AUM. In order to scale and become an extremely large financial organization, it's very hard to trade accounts and actively trade accounts on a regular basis. So they'll put you through a risk tolerance, and unfortunately, they're going to try to put you in one category or another. So let's just say the reason that they do this is ultimately they can go into one of these portfolios. Let's just take the balanced portfolio, for example, and they can make 1 to 2 changes inside of this portfolio, and it blows out to thousands and thousands and thousands of people. And that's what they're going to call active management. And the real reason that they do this is scalability. And how do I know that? Because ultimately, this is how we had built our previous firm. So back in 2017, we sold our previous firm that we had built to about $5 billion in assets under management. And we did it exactly like this. Scalability, the ability to have multiple managed accounts, all of those different things. In 2017, when we sold to our minority shareholders, we took a step back and we asked ourselves, how would we manage our own money? And what would we ultimately want to do? And there are a couple things that came out of that. We went out and we looked at kind of the best in class as to who really manages money well. And what came up over and over and over was the endowments. You can look at Yale, you can look at Harvard, you can look at all of these different types of organizations that are managing big bulks of money. And 3 things that came out of that. Number 1 was volatility is built into the market. Okay, and volatility is here to stay. The second thing that came out of that, which is important, is non-correlated assets, to the market, which also will produce passive income. That's critical. And the third thing that came out of that as we did our analysis was taxation. Taxation is one of the biggest wealth eaters that you can have out of there. Now, let's go through why this becomes so important. Going back to the traditional model over here, you're going to have the stock market. It's going to go like this. Okay, and it's basically that heartbeat that everybody's talked about. And traditional investment theory is going to tell you to buy and hold. And over time, if you buy here at some point in time, you're going to go like this, and the markets are going to get higher. And you're going to ultimately have more than you'd put in. The challenge with this investment theory is twofold. Number 1, very rarely do people ride out these large downturns that are here. Things happen, people get scared. Go back to 2008, go back to 2009. You could even go back to the COVID pandemic when the markets fell off a cliff and everybody gets scared, and there's all kinds of adjustments that are made here. And ultimately, we don't stay the course. And so if you don't stay the course and you make an adjustment, now all of a sudden your portfolio is here because you didn't capitalize on the up market. Or moreover, let's say you're pulling income. And during any one of these downtimes, you're pulling income. Again, your portfolio doesn't get to achieve this. All of a sudden, you're here because at some point in time, you're locking in some of these losses when this ultimately happens and you've got the downturn in the market cycle. So when we look at it, if we believe that volatility is here to stay, and we believe that the markets are going to continue to do this, then why be beholden, or let's say a victim to volatility? Let's use volatility as an asset class. So if you look at 40 of the largest 50 volatile single days in the market have been within the last 2 years, 10 years. So if you look at the entire history of the market, 40 of the last 50 are in the last 10 years. That becomes really impactful because if you're ultimately riding this out, you are going to at some point in time depending on when the downturns happen, you're going to have muted returns. And so when you go back to the old model, again, they're doing this to be able to gather assets under management, but they don't have the ability to maintain or actively trade your accounts. So as we started the organization, we said, how are we going to manage our money? And if we know volatility is here to stay, let's take that same concept and let's take one of our portfolios that is supposed to perform in the market. Everybody, let's just use Apple. Everybody knows what Apple is. Okay, so we build our high net worth portfolios with actual equities instead of mutual funds and ETFs and things of that nature. And we do it for a multitude of reasons because obviously as you get into indices and mutual funds and ETFs, they're dominated by the top 10 to 15 names in the market. The Google, the Amazons, the Metas, people like that. But let's just go back and say, why do we use individual equities? So let's say we've got Apple. We're going to set an entry and an exit point for when we like Apple. And let's just say that Apple happens to be at 118. It's not, but let's just say it's there. But we want to get in at 100, okay? And we want to get back out when Apple turns at 115. So come along, use this same volatility cycle that we're talking about. And let's just say here's our 118 mark. Well, once it starts to get down here to 100, we will begin to enter Apple very slowly. And just for example, let's say we want a 4% allocation of Apple in the overall portfolio. When it gets to 100, we're going to take 1%. And Apple may go down again because we know about the volatility. And let's say it gets right here, we're down to 95, we're going to take another 1%. And it's going to gyrate and we're going to start finding support here. Goes back up to 98, we'll take another 1%. And it may get back up to 100. We're going to take our final 1% to equal the floor in the portfolio. And then once it gets back up here to the 115 mark, we're going to get out and we're going to sell it. But we still like Apple. And you may say, well, what happens and you miss this whole section here? That may happen. But what happens in the cycle is it comes right back down here. But because we still like Apple, we'll let this do it again. And we may take another 1% here, another 1% here, another 1% here, another 1% here. And when it gets back up to the 115, we're going to sell it again. And we're going to do that over and over and over. And so instead of going up and down, up and down, up and down, up and down, we're going to use volatility of each individual holding and capitalize on getting in and out at our entry and exit points. And we're going to cycle that multiple times. And if we go back to this volatility metrics that we talked about, and if 40 of the 50 largest holdings are the largest top to trough days of the market in the last 10 years, we have several opportunities to go through and do this. Now, each one of our higher net worth portfolios is going to be made up of 40 to 45, maybe 50 individual equities, and each one of these are being actively managed and traded on a daily, weekly basis. Now, the reason that this is done and not done over here is scale. This is extremely difficult to do it this way. We have an entire department of analysts and traders that are working through this in a 12-member investment advisory committee that is helping make these decisions on a regular basis. And it starts with a philosophical difference between traditional investment management and what we're trying to do, and the fact that we're not trying to be the largest investment firm. We've done that. We've built one. We sold one to do that. And when we looked at how do we want to manage our money, this was the main point. So we're not going to be just a beholden, right, to the volatility. We're going to use it as an asset class. The second thing that becomes extremely important is non-correlated assets. So if we believe that volatility is built into the markets and it's here to stay, how can we start purchasing assets at the client level that aren't correlated to the market? And we do that through private real estate, which again produces passive income that doesn't go up and down. And the reason, let's start with private real estate, the reason that we believe that is so important, and every market cycle is different, but the reason we believe that's important is all higher net worth people believe that private real estate is a great way to create wealth. We do too. But they don't do it because it's hard for them to buy a building. If they do rental properties, they don't want to be called in the middle of the night. So we will set up individual holdings for each property, and our clients get to buy in share classes. But ultimately what happens with real estate is it's not that it doesn't change in value, it's that you don't have it, it's not being checked on the value every day like the stock market. You can't log on and see what's the value of my house at this ideal moment or my rental property at this ideal moment. You'll have trends and you understand what's going on, but because we're not selling at any point in time, there is inherent volatility. But all along the way, it's producing monthly passive income, not correlated to the stock market, right? And real estate has always helped portfolios grow and build better. So if we overlay this, the passive income is what you care about because it's what is it producing on a monthly basis. I'm not trying to sell that particular individual holding. And so if we overlay what the market is doing, not to say that real estate isn't somewhat going to follow the markets, but it has a less volatile cycle and it's constantly producing income. And then if we come down here and we look at taxation, the way that we do private real estate is generally extremely tax advantaged because as a limited partner in each holding, you get all of the depreciation aspects of real estate, as well as if there's accelerated depreciation, cost segregation, all those different types of things that come along the way. So your passive income is extremely tax advantaged. The other thing that we will do, so if we look at our non-correlated and passive income, so we've got real estate that's built into the portfolio. The other thing is we've got extremely high net worth insurance policies that will grow vastly in cash value. They operate very similar to what the real estate's doing. As we transfer assets in, they grow in a tax-free environment, just like one of the things we talked about that's very important, and you can pull cash flow from them tax-free. But along the way, they're not correlated to the stock market at all, so there is no volatility built into them, and they can provide a very important aspect, much like a bond portfolio, where they're going to grow at a 4.5% to 5% annualized basis with no volatility to the stock market. So if we go back and we look at our three key tenets, actively trading portfolios using individual equities, not being greedy, getting in and out at our entry and exit points, producing realized income and gains at the time, and then deploying those into other sectors that we think are very important. Add on our non-correlated assets, which are the insurance and the real estate piece, both of those that don't have the volatility of the traditional stock markets, will grow at a very predictable rate and produce passive income. And both of these non-correlated aspects that we're talking here are extremely tax advantaged. So when we look at this versus the difference, it comes down to two things. Our investment philosophy is one to help clients create wealth. We're not just trying to manage money. This is just managing money, and the whole concept there is accumulate more. And if you can accumulate more, then at some point in time, hopefully you have enough to withdraw. Our entire philosophy is how do we treat you as a client to reduce your risk, but create significant wealth. Now, how does this come to fruition? Every account is obviously different, but if you look back at 2022, when the markets were down 20 to 30%, depending on which index you were looking at, our all stock-based portfolio was only down 7. And so if we can limit the downside, fast forward to 2023, last year when the S&P was up 26, our all stock portfolio was also up about 26 net of fees. So if I can limit your downside, protect you to the volatility, but capture most of the upside, long-term, you're going to create much, much more significant wealth. In addition to that, if you were to take a client or a hypothetical client and think about the real estate and insurance investments that they may have that were not correlated to the market, they may have been net neutral in 2022, even with a portion of their stock portfolio being down because of the other assets that are producing passive income and are not correlated to the market. Then we fast forward to last year, 2023, the markets go back up. These still are doing the job that they're supposed to be doing, but we're capturing the upside. It's a very different philosophy than this. And the last thing I will tell you, the reason we did it, this is how our shareholders' money is managed. We are side by side, all of our clients and all the portfolios that we do. The way that we manage our own money is the same way that we manage clients. And we believe if it's good enough for us, it should be good enough for them. So that's the difference between traditional investment theory and what you're getting at most places and ours. And now again, I'll leave you with 3 key aspects. Volatility is here to stay. We want to take advantage of the markets when they're up. We want to limit the markets when they're down. Limit your risk. We want to be associated with non-correlated assets to the stock market that produce passive income and continually will produce some form of yield to help smooth out the volatility. And we want to be very cautious of what tax rates are doing and the impact of taxes on your investments. So hope you enjoyed our short little illustration here. If you have any questions, feel free to reach out to one of our advisors. Thanks.